Hey guys, I wanted to do a video on this article, and not just this article, but I'll start here. Sort of a series of videos. I'm hoping basically on things that seem really important to me that I feel like I have a very poor understanding of. So that may not be very useful for you. I'm very sorry, but I want to create a record of these and hopefully start unpacking them over time, or perhaps if I get some viewers, get some comments back, helping to understand these important issues. So the article today I want to get into is this one from Reuters about the Federal Reserve key rate, their policy range, and how it relates to bank reserves. So I feel like there's something very important in here, implicit in here about the way money moves that I'm not quite understanding. So I'm going to give this an article read through, point out what I don't understand, and point out what I'm inferring from this, and take it from there. Soothing words from Fed as rate hits ceiling for first time. Federal Reserve officials have tried this week to ease concerns on Wall Street that bank reserves are growing scarce and that the Fed's key rate will edge up above a policy range, possibly forcing it to permanently hold more assets than planned. Thursday marked the third straight day in which the federal funds policy rate traded at its effective ceiling of 2.20%. Before this week, the policy rate had approached but never landed on the rate the Fed pays banks on excessive reserves, activated in 2015 to keep the policy rate contained. The policy rate has drifted higher in its range throughout the year, causing the Fed in June to tweak the IOER lower. To provide a buffer, it now sits 0.05% below the upper end of the overall policy range of 2 to 2.25%. The upward drift has renewed a debate over whether the Fed's reduction of its massive bond holdings, which started a year ago, has made it more expensive for banks to borrow excess reserves to meet regulatory requirements or fund their daily needs. Reserves have fallen more quickly than the Fed's portfolio, leading some in the market to believe a scarcity is behind the upward creep in the policy rate, and that the portfolio trimming would have to stop soon. That, in turn, could leave the Fed with a more accommodative policy stance overall. If one thought that the drift higher in the funds rate were the result of growing scarcity of reserves in the interbank market, then it would signal to the Fed a need to slow or stop pulling reserves out of the banking system via their balance sheet normalization, wrote Michael Feroli, chief U.S. economist at J.P. Morgan. He added, however, that there was so far little evidence that reserves are becoming scarce. Central bankers agree. Cleveland Fed President Loretta Mester discussed the issue twice over 2 days of events in New York, telling investors on Thursday that a series of other one-off factors was driving the policy rate's upward drift, including the supply of Fed funds from government-sponsored home loan banks. Another downward tweak to the IOER to provide more of a buffer wouldn't bother me, she said. We could think about that separately from the ultimate size of the balance sheet and longer-term operating framework, Mester added. Hours later, at a conference on Friday at the Bank of France in Paris, the Fed official running market operations argued that even if the effective policy rate rose above IOER, it would not signal reserves scarcity. At any rate, it was unrelated to any future decision on how much to shrink the current $4 trillion in bonds on the Fed's balance sheet, said Simon Potter, executive vice president at the New York Fed. Quote, "Let me be clear. Observing the policy rate and other rates above the IOER is not a sufficient condition for reserve scarcity," Potter said at the conference. The Fed bought some $3.5 trillion in dollars in bonds to spur recovery from recession in the last decade, leaving it with a total of $4.5 trillion in overall assets as of October last year. Since then, it has shed some $250 billion, even as bank reserves have dropped by more than twice that value. The Fed has never specified how much it wants to trim its asset holdings. So, a lot of important stuff going on here, I sense, but a lot of things I don't understand. It's important because it's respecting, of course, the Federal Reserve, the policy rate, which sets virtually all of the interest rates in the world. I mean, it's correlated to them. It has an impact on virtually every interest rate paid on any debt in the entire world. And I really don't think that's hyperbole. It's not just restricted to the United States in its impact. So there's something in here related to how the policy rate works that I'm not understanding. In particular, how the policy rate, so a couple things that are being mentioned here that I think are important that I don't understand. Just, I guess, flagging for now in hopes I can remember this, move on, gain a bit more knowledge. How is the federal funds rate, the policy rate, related to banking reserves? Why are these analysts or investors or these individuals speculating that that the reserve decline is related to the increase in the fund's policy rate, or rather related to the lowering or diminishing of the Federal Reserve balance sheet? I don't understand that supposed relationship. And this article doesn't really explain it to me. This is really, I think, the key here. Banks are borrowing excess reserves to meet regulatory requirements or funding their daily needs. Now, hold on a second. I mean, we're talking about capital reserves. How the heck are these banks borrowing regulated reserves? That sort of defeats the purpose, doesn't it? So there's a flag there. There's pieces I don't understand, but there's just a flag there that's got me concerned about this relationship. Why? There's something here I don't understand that is going to be important here as the Fed reduces its bond holdings. If banks can't borrow excess reserves, first of all, how are they allowed to borrow their reserves? That is clearly defeats the purpose of having a capital cushion. And why is the Fed selling its bond holdings, making it more expensive for banks to borrow excess reserves? I mean, if you have some thoughts, and if you're watching this video, please comment below. Help me understand that. That would be fantastic. And also, if you have any thoughts on why the policy rate is drifting higher in the range, that's another thing I don't understand. And also, something I don't have a very specific, concrete understanding of is how, in fact, exactly is the policy rate set? That federal funds rate that is so important and published so widely. I realize I don't actually know the mechanisms that the central bank uses to create that rate. I'm sure I've read it before, but I can't recall it right now. So if you are watching this and you do know, please comment below. I would really appreciate helping me out. So I think that's it for now. Some important things I don't understand, at least make a record of them. And if anybody listening to this has any idea on any of those subjects, I would be very curious to hear your input. Thanks so much.